4.5 minutes before the closing bell rings, the NASDAQ is on pace for its first losing month in the last half year. The major averages mostly down for the week, but as I told you, it's been a really nice quarter. My next guest says he sees something on the horizon for next year. He's about to tell you what that is. Randy Anderson is chief economist at Griffin Capital. Okay, what is it? It's not good.
Well, first of all, thank you so much for having me here today. What a great show and what a great news week it's been. You know, there's been a big, first of all, everybody has still had the momentum carry for the Trump trade, and the stocks have been going through the roof. But when you look at the fundamentals of the economy, we're looking at a 1.5 kind of average GDP growth for 19 and 20. So when you think about the multiples...
Wait, sorry, 1.5? Yeah, we're at 4.2%,
well, we think that was one quarter.
Yeah.
We think we'll end the year somewhere around that 3% range.
Okay.
But we think it's going to slow in 19 and 20. Now, listen, everybody's talking about the trade wars, and everybody talks about the different kinds of geo risk. But the employment market's almost at full employment. There's not a lot of gas in the tank when everybody's already working, number one. Number two, LIBOR has really increased, which makes the cost for individuals and cost for businesses higher.
Yeah, that's
so
the
corporate
London
profits are starting.
Interbank offered rate that banks overseas charge each other.
Which makes all the loans that adjust go up, and that hurts companies, and it also hurts the consumer. The consumer really makes up a big chunk of GDP.
Well, so why do you like real estate investment trusts? If we are in a rising rate environment, mortgages are going up, who knows what else?
Well, the first thing is real estate is a great hedge against inflation. And what we're seeing in the data is slower economic growth, but we're starting to see inflation creep up.
That's true.
While basic inflation is creeping up, construction cost inflation is going way up, which means to pencil out new projects, you got to get existing rent to grow. So you're not going to see a lot of new supply. So the economy is growing just strong enough to increase demand, but you're not seeing those extra buildings.
What you like about certain publicly traded real estate investment trusts, the short name for it is REITs, is that these have longer leases. It's not like residential real estate.
Sure, they got good, strong, contractual, durable income. And when people start to get defensive and they want that good, consistent income and lower volatility, they move to hard assets. So they tend to perform really well when people start to get defensive and they want that income, they want that hard asset and inflation hedge.
It's 2 minutes now before the closing bell rings. Yep. Randy, the S&P is having its best quarter since 2013.
Yeah.
People a year ago were saying it's the best since then. It's the number, X number of record highs time after time. Trees don't grow to the sky. That's an old Wall Street adage. Yep. Are you nervous at all?
Well, sure. I'm nervous. I mean, asset prices are high. It's the time when nobody wants to diversify because they're all looking in the rearview mirror going, hey, I want some of that. That's the time to make sure you've got your portfolio diversified. You got some defensives in there because at the end of the day, you know, the markets are going to correct and come back to a little bit of a normalization as we continue. We'll still see growth. You know, I'm not forecasting a recession, but valuations don't make sense given where corporate profits and where the GDP is going to go.
The tax cut has been a boon for corporations,
it's been a great boon. Yep.
and certainly for the individual who finds more money in his or her pocketbook. Yep. You worried about debt way down the line? I mean,
I am, and those things start to create drags on the economy. That's part of what our forecast is in 19 and 20. But listen, it was great short term. There's also good things in place. I think the economy, again, without some pretty decent action by the Fed and without some pretty good action by the government officials, we wouldn't be where we are in the economy today. I'm just talking about kind of slowing back a little bit because we've had a long recovery, but in a long recovery, still getting positive GDP growth is not a bad thing in still a relatively low interest rate environment.
Do you see any black swans or unexpected events that are negative for the markets on the horizon?
Well, sure.
I suppose they're not black swans if you can see them.
Well, sure, they're not black swans if you see them, but you know, I think that people worry about the Fed getting too aggressive. I don't think that they are. They don't want to be the Fed that comes in and inverts the yield curve. We got a president. We got midterm elections coming up. He's the economic president. I don't think he's really going to do anything. I think likely it could be some sort of trade war escalation. It could be some problem that happens globally. But at the end of the day, we only have about a 12 to 15% chance of recession.